folks. Good afternoon. It's Dave Burrows. I'm Chief Investment Strategist and CEO here at Barometer Capital Management. I want to thank everybody for joining today. We're getting into the meat of earnings season. We've had now about 10 days since the first couple of wild days of rotation with the Russell 2000 lifting off for the first time in 2 years. And we've had some time to assess kind of what's going on, what may be changing, what's staying the same, and if there's anything that's required in our client portfolios, just from a strategy perspective. Certainly just as we always do, I want to start from a high level. We believe we're in a structural bull market that kicked off in 2013 in the US. It's broadened into other countries. When we look at the S&P chart over the last two secular bull markets, we know that there are great runs of 2 and 3 years, but they are punctuated with corrective periods, either in time or in price. Cyclical bear market tends to be kind of 20 to 25% pullback. They are more tactical. They tend to be lower bound by a rising 200-week moving average, which of course this one has been. When you get out of one, like the 25 months we came out of recently, you tend to get 2-3 pretty good years. And through those periods, people will talk about the fact that the market's making a lot of new highs. That's not a bad thing. That's a good thing. People will talk about the fact that the markets have very low volatility. That's a good thing, not a bad thing. And there will be lots of people who have been left behind, who will tell you all the reasons why it is that the market shouldn't be going up and why there are problems that we need to solve. The net of it is we are big believers in understanding the message of the market. What is it telling us? What's changing? What's staying the same? Your best stock can stay as your best stock for a long time. And so I do these calls weekly for our clients to make sure they understand kind of what we're doing in portfolios and how we're thinking about things. We do them for people who are getting to know us, to understand what drives us, to see if it makes sense to them. So as we move along, you can see we've had a number of, these are monthly bars, positive months. With the month of April, we had about a 5% pullback, but of course it was recaptured in the month of May. June was higher. Now we're higher, about 1.9% in the S&P in the month of July. When we put the market under a microscope, you can see that little pullback in April, briefly broke the 50-day moving average, but then got back into gear. And we've been marching along above the 50-day, the 21-day moving average, and the 9-day moving average, which is the way the market should be when it's kind of in trend. Now, we have talked, as lots of people have, about just how few stocks had been beating the market over the course of the year. Only 25% of companies in the S&P were at or ahead of the index. That's something that doesn't tend to go on forever, because in fact, actually in more years than not, the equally weighted S&P has outperformed the market cap weighted S&P, the one weighted by the biggest companies. Now, it's been well discussed, but from March 28th on, the equally weighted S&P failed to make new highs, while the cap weighted S&P was making new highs. And that was a concern to us. And we talked about the fact that markets correct, after a big run in one of two ways. They correct in time by going sideways, or they correct in price. And you never know what you're going to get, but you do know you're going to get corrections. Well, one of the things that we focused on was that the average stock was trading at a reasonable multiple, while some big stocks with lots of growth were trading at much higher multiples. Well, the month of June was the first month where we didn't have a rate hike. That's a shift in monetary policy. Not one rate hike around the world. In fact, we had some rate cuts. So liquidity seems to be coming to the market. Markets like that. And so on the 11th of July, the equally weighted S&P broke out above that downtrend line and had a good, sharp few days higher. Now, things don't go straight up. So we've had a couple of days of retracement, but market basically found support where it should, at the point where it broke out. And it's looking decent. When we look at the Russell 2000, this was really the story. The Russell 2000 had 5 days in a row where there were greater than 75% of stocks advancing versus declining. That's an unusual thing. And in fact, it's something that tends to happen at market bottoms, not at the point where people are worried that you're going to get a correction. This, to me, is a really positive sign. It's a sign that buying spread out to a much broader number of securities rather than focus on just a small number that everybody owns. Why did that happen? Well, we got CPI data that came in with a lower inflation number. That gives people confidence that the Fed will cut at the very latest by September. We had the unfortunate incident with Trump's assassination attempt, which frankly made it more likely that he gets elected. That's seen as positive for smaller and mid-sized domestically focused companies who would like to see deregulation. And frankly, with rates coming down a little bit, that's a positive for small and mid-sized companies because they tend to have more debt and a higher cost of capital. Of course, the Apples of the world borrow money for almost nothing. But if you're a $3 or $4 billion company trying to access capital markets, that's more expensive. So the combination of these factors really lit a fire. Now, there's a couple of things we need to know. One, hedge funds were highly, highly short the Russell 2000. They were using this as a hedge. Their assumption was that if the numbers, if the market got weak, the Russell 2000 would be weaker because there is more debt. The balance sheets aren't quite as good. So what we probably got a combination of real buying and some short covering. A lot of people and a lot of hedge funds with very significant short positions were forced to cover at elevated prices. To put it in perspective, the Russell 2000 was up 10% over a small number of days. And lots of important and smart people looked at the numbers and said, look, this can get a lot better. Tom Lee, who's been one of the bulls on Wall Street, has been dead right over the last few years, went out on a limb 2 days ago and said the Russell 2000, is his opinion, could rally 40% by the end of the summer. Now, that's an outlier view, but it can happen. You know, assets that are under-owned and that start to act better can attract capital, and especially if participants are short. So this blast of buying in small caps is a positive thing. If you go back to 1979 and look at all the periods where the Russell was up 10% or more over 10 trading days, the forward-looking numbers were pretty darn good. 12 months out, on average, the market was up 27%, and it was up 86% of the time. Again, we don't make decisions based on this, but we do like to understand what the numbers tell us, and we like to understand the range of possibilities. So back to regularly scheduled programming, people often get concerned about some seasonal weakness in the month of August. Now, it's been our view that in a year where there is a re-election of a sitting president, it tends to be that the market's pretty benign. August, September, and October, more benign than normal. Clearly, the situation's changed, so we have to watch that. But as it sits, the data right now points to markets being relatively benign. And with an expanded breadth reading, it means that the market has a greater ability to absorb shocks. When breadth is expanding, the market tends to be more resilient. So whether we have seasonal weakness or not, my guess is it will be pretty shallow. So things in general going pretty well. When we look out over the last 10 days, you know, it's interesting. It's a very bifurcated market. The S&P was down about 0.33. The NASDAQ, which has been a beast for a year, down 1.95. The Russell 2000 up 4.5%. And the S&P small cap index up 4.6. That's a real divergence and something that we want to keep an eye on. So all of this data is positive. and is a supportive case for being long equities. So outside the US, global markets, continue to act pretty well. The Nikkei 225 has just broken out of a 30-year base of deflation. The Indian market acting pretty well. We talked a little bit about Taiwan. Taiwan was down a little over the last week. Taiwan Semiconductor got caught up in some weakness in semiconductors, so pulled back a little bit, but still looks very, very constructive. And of course, the Canadian market, which we have said looks more like global markets than the US market based on our sector weights, went out today very close to an all-time high. So in the month of July, it's up 4.4%, outperforming both the S&P and the NASDAQ by quite a substantial margin. So equities look pretty good. When we get to fixed income, our view has been that 2020 was a generational low in rates, and that likely we have a period where rates will work their way higher in fits and starts, where each business cycle you get rates come down a little bit, but probably to higher and higher lows. So it appears right now that we are at a point where maybe rates can come off a little bit. This is the 10-year Treasury yield. This was the low in rates. We had a series of higher highs and higher lows. And you can see, really, this is the first time we haven't made a higher high. And it's not like things have gotten a lot better. If you look at the TLT, which is the long end of the US bond market, since 2020, at the worst point, it was down 54%. It's a tough pill to swallow if you're a conservative investor. Really, as we sit today, it's not much better, still down 48.5%. Now, lots has been made about the idea that when rates come down, it will be a good time to buy bonds. We think there are headwinds. One of the biggest buyers of US Treasuries in the world, the Chinese, are concerted sellers. So where the US has depended on the Japanese and the Chinese and Saudi to be big buyers of US Treasuries, all of them are busy buying gold and selling treasuries. That's something just to note. These aren't cursory decisions that they're making. They're making reasoned, thought out decisions. And it may well be that they're just trying to make sure that they keep capital out of the hands or the reach of the US Treasury. That's possible. But nonetheless, the traditional buyer of the last many years of US long treasuries is really not in the market. So it's left to domestic buyers. When we look at our choices, and we have lots of flexibility in the mandates that we choose right now stocks over bonds. Stocks since 2020 have very consistently been as good as or better than bonds, with about the same volatility. In fact, through the bear market in 2022, stocks actually outperformed bonds. And certainly since the market low in October of 22, stocks have been rallying ever since. When we compare dividend growth stocks versus fixed income, this really hits home. So yes, you can buy bonds if you think rates are going to go down, and they'll go up a little bit. You'll get your coupon. Our premise has been that, frankly, dividend growth stocks will do even better. There's enough disenchanted bond investors who would like to reduce their positions in bonds and get a rising stream of income to offset a rising cost of living. And you can see, as we went out today, we are now at multi-month highs of dividend growth stocks versus bonds. And we think in our income strategy, where we have the flexibility to do whatever we decide to do in buying income producing securities, the dividend growth stocks are better suited for where rates may work their way higher. Even small cap dividend growth stocks have now joined the party. And this is something that's interesting because there's lots of companies with great dividends, with really good dividend growth, companies that are generating excess cash and pay it out to their unit holders. So not so bullish on bonds. Commodities, we think the commodities made a low in 2020. They have been held back by the rate hike cycle. And certainly, if you're a hedge fund and you are concerned that higher rates are going to choke off the economy, you might use commodities to be short, to bet against the economy. Now, over the last 2 weeks, commodities really haven't been able to make any headway. And I have a premise. there's a lot of people who need to have short positions against their long positions. And if they've been squeezed in on their Russell 2000 shorts or their small cap shorts, they're looking for something else to short. And my guess is that some of that money has found out its way into a bet against energy or a bet against metals. But I would say from a chart perspective, we broke out of this consolidation. We're above the range. We're above all the moving averages. The moving averages are headed higher. Maybe we have to wait a little bit, but I think that this group looks pretty attractive. When we look at the point and figure charts, this is the US Commodities Fund Index. You can see it's a steady series of higher highs and higher lows. That's really positive. On gold, this is a universally hated asset. And funny enough, it's having a wonderful rally. If you look at it, gold is higher or flat in 8 of the last 10 months, as gold has moved from $1,800 to $2,400. It's a pretty good move with no private investors on board, and frankly, no institutions. Most institutions look at precious metals as a very, very small asset class, and they say, why bother? Of course, it was a very long wait from 2011 to 2021 to break even for a lot of investors, and then sideways from there. So I can understand why people are skeptical, but I do think it's notable that so many central banks have been buying gold with both hands, as opposed to treasury bonds. And my guess is if you were to take the time to look at gold in euros or gold in yen or gold in British pounds, it looks a lot better than gold in US dollars and the US, because the US dollar has been relatively strong. And we were looking at that this morning. If you're living in Europe, gold is doing its job of protecting against overprinting of currency. So seasonally, we're in a strong period. My guess is the equities can perform pretty well, but certainly the setup is attractive, and we'll see where we go from here. The last time we had this same kind of bear market, once you broke out, you had almost 4 years where gold went up 350%. And my guess is the setup is probably pretty similar. So we do own gold in our portfolios as opposed to owning bonds. In fact, over the last 2 years, gold had been less volatile than treasuries, and certainly has been giving a positive result. So silver looks about the same. And as we've talked about before, there are shortages in the market, which can move prices higher. Agricultural commodities are reasonable. And when we look at across the mandates that we're running, equal weight S&P since the beginning of the year is up 8.5%. TSX up 11, aggregate bond index up about 0.5%. Our income portfolio, which people use to fund their lifestyle, is up 16.4%. Our equity portfolio up 15.8, and our global portfolio up 10.8. So we're really pleased. These would all be top quartile numbers, I think, so far year to date. Now, of course, we don't have to be everywhere. Our job is to target. We're working at trying to identify market leadership and focus in those areas. We want to own assets that are being revalued where there's some structural change taking place that supports higher prices. We're always watching for signs of new leadership. Of course, we would like to have portfolios diversified. We don't want to be overly concentrated in one area or another. And in the event that something that has been working stops working, we have a very clear-cut selling strategy to make sure that we are tactical and don't leave those profits on the table. We want to protect them. And that's an important point right now. 70% of returns in our view comes from being in the right neighborhoods. And then we try to enhance returns by finding specific securities that are good getting better, where we can see in the financial metrics and in the way that the stock is trading that something's changing for the better. And so we have a top-down model that tries to identify the right sectors and themes to focus our attention in. We have a bottom-up process and investment team that looks at single securities to try to find those that are just simply better than their peers, where they're having an easier time raising capital, an easier time selling their products, an easier time hiring best employees. And this is a living, breathing universe that we hold at any given point in time. Right, as most people know, 20 to 30 securities per portfolio. We don't own 150 stocks and look just like the market. And that portfolio does change from time to time based on conditions. We're always watching for parts of the market where over time more and more stocks are participating. Often, when a group starts to wake up, it's universally hated. Often, there's one or two companies that are behaving better than the rest, but nobody cares because it's a sector that nobody's made money in. But as money flows in, slowly people get interested and breadth will expand. More and more stocks participating is a healthy market. That's why we're so happy to see the Russell 2000 wake up and the average stock wake up. It tells us that there is money to be put to work. Now, at the same time, if there's rotation going on, we want to say, well, what is it that maybe isn't getting as much money as it was? What maybe is a little bit crowded? Where are the risks a little bit higher? Probably lots of great companies, but if you don't have the same money getting put to work, certainly it's something we need to think about. So tactics are really important. Our job is to make sure that one leading security, when it starts to wane, hands off to a security that's just starting to lead. And that way we keep the portfolios fresh. So a number of weeks ago, the breadth data that we were following was a little bit sloppy. Market had a great run from October into April, and then we saw some deterioration in breadth under the surface. Some groups that had been doing poorly continued to do poorly, like the defensive sectors, consumer staples, real estate investment trusts, utilities, were all having a difficult time. But since then, we've seen marked improvement in the breadth data that we follow. And when breadth is improving, that's when we want to make sure we're pretty fully invested. I thought this was an interesting graphic this week. This looked at three universes, the S&P, the NASDAQ composite, not the 100, the broad NASDAQ, and the Russell 2000. And what we're measuring here is the percent of members within those groups that are trading above their 200-day moving average, a long-term measure of trend. I thought this was really interesting. So the S&P, 76% of stocks as of the end of last week, as of the end of yesterday, 76% of stocks above the 200-day moving average. That's almost 80%. That's really healthy. That's good breadth. Percent of stocks in the NASDAQ composite above the 200-day, only 52%, which tells you how concentrated the leadership has been. But look at what's happened in the Russell 2000. We've gone from about 46% to 70% of stocks being above their 200-day moving average. That's a significant shift, and that's something that we want to keep in mind. Now, we're into earnings, and it's going to be an important earnings season. When we look at the history of earnings relative to consensus estimates, earnings started to wane in 2022, and by the fourth quarter of 22, we were into negative earnings growth. So markets started to roll over at the end of 2021, and it was prescient. Investors could see earnings were coming off the boil, and they had their worst quarter in the second quarter of 23. So markets tend to look 9 to 12 months ahead. Shouldn't be a surprise that in October of 22, the market bottomed and started moving higher. While lots of analysts said, no, they shouldn't go up because the earnings are going down. Again, the market's looking ahead. This is the first quarter where more than a small number of leaders will have substantial earnings growth. And not only that, the expectation is margin growth. Now, we're just only starting the quarterly reporting period, so that remains to be seen. What do we care about? We care about, one, do the numbers come in as expected or better? They should come in a little better. And two, how do the markets respond to those earnings? Some companies that are crowded may wind up, even though they have great numbers, disappointing the most bullish investors. Today, we get Google and Tesla reporting. We'll see what happens. My guess is there's a pretty high bar to reach, but we'll see. And as we go out through 24 and into 25, earnings should accelerate. Let's take a look at what the market's telling us coming in. We talked about this last week. This is the financial sector, the XLF ETF, 2007 through 2021. Going nowhere, well, a long way, but nowhere in making new highs. That's a secular bear market. When we broke out in 2021, it was on the back of rising interest rates and increasing inflation. generally pretty good for financials. We went through a tightening cycle around the world. And a few months ago, investors clearly started looking beyond the tightening cycle because we've had 1, 2, 3, 4, 5, 6, 7 up months, one flat and one down. And we are sitting now at virtually new all-time highs for the XLF. When we start making new highs after many years, that's the beginning of a new bull market. And we could see it over the last while in the way that some of the large caps were behaving. We talked about Goldman Sachs, probably the most market sensitive stock on the board. They make their money in mergers and acquisitions, share issuance, and in trading. And they do have a wealth management business, but it's not big. The estimate for this year, $36.80, up 61%. Their earnings blew the doors off last quarter. They report in another 84 days. So we'll see what happens. But as it sits right now, we've only just recently made all-time high, a step up today, up 1.3%, trading better than 90% of stocks in the S&P. I would say investors here are not expecting a major market problem. We've talked about insurance. Reinsurance Group of America is one of our top 20 holdings. Today, up 3%. Earnings come out 9 days. The whole insurance group is acting well. Property and casualty and life insurance. Manulife would be another large holding of ours. Fairfax Financial, Progressive, all of them are behaving really, really well. And then, of course, the exchanges. This is the TMX Group, the company that operates the Toronto Stock Exchange. And you can see what the market is doing in their voting here. This has been up on a row, better than 83% of companies in the last 52 weeks. So financials are clearly leading this market. And for the market rally to be sustainable, we'd like to see the financials participating. This is an important group. It's a group that does generate a lot of cash flow. It's a group that does tend to pay higher dividends over time. Goldman Sachs pays a 2.5% dividend that will grow likely at about 20% a year over the next 3 years. We think that's pretty attractive. Technology. This one has been a little bit of a conundrum. Early in the year, relative strength waned. There was another big bout of buying of technology shares leading into June. And you can see over the last 8 days, while the Russell 2000 took off, there was some profit taking in technology. The XLK ETF, made up of the largest tech stocks, down about 5% over the last 8 days. So the question is this just a wobble or does it carry on? Most people who've been watching this webcast know we have had a significantly reduced weight in technology, given the fact that there are other things to do. And given the fact that tech probably is a little bit more crowded. These are the cumulative sector ETF flows since October of 23. You can see a ton of money in. Then when we got the wobble, some money started coming out. But we have seen a big pickup in the flows into the non-tech sectors. We think that's really positive and one we want to keep an eye on. In a previous webcast, we talked about the fact that semiconductors, which are really, really important to the AI movement, are a little extended. You know, we went back over the last few years and looked at just how far they tended to get extended above the long-term moving average. 80%, 70%, 50%, 104%. You know, recently 73% above the 200-day. And when they did get stretched, they corrected, either sideways in time or in price down toward the moving average. So look, we are bullish on technology. We are bullish on the use cases for AI, but we are realists in knowing that no matter how good a company, they do correct. When we at NVIDIA, which we own now, I think at an adjusted cost of about $14 a share, we've trimmed a number of times along as the team looked at it, getting to be a larger and larger position in client accounts and thinking that they do correct, and we do have to be a little cautious. In 2022, the stock pulled back 65%. It went sideways for 217 days when it was 170% above the moving average. When it was 190% above the moving average, it went sideways for 148 days. And recently was 340% above the 200-day moving average. That's extended. Now, when we look at it a little closer, the stock made a high in the month of June. And when the S&P and NASDAQ made a new high, and when semis made a new high, NVIDIA did not. That's something to watch. This is supposed to be the leading stock. And when it doesn't make a new high, when the market does, that's something I want to take note of. We also got a 3-day reversal on fairly high volume. Now, we made a lower high and we pulled back now to the 50-day moving average. At the same time, the breadth model that we follow for the NASDAQ 100 that measures the percentage of stocks in uptrends started to pull back. That gives us a little bit concern about that universe. When we look at semiconductor bullish percent, the percent of stocks in uptrends in July at the highs, 60% of companies in the sector were in uptrends, whereas in March, 66% were in uptrends, fewer stocks in uptrends. And that's pulled back over the course of the last 10 days to 44% when we've back today broke below that level. So we look at risk at the company level, we look at risk at the market level, we look at risk at the sector level, and this gives us less confidence. Look, we think NVIDIA is a world-beating company, and it has been very, very good to us. And we had a long conversation last week about, do we trim it? And we have rules. When something changes, we have to acknowledge it. So we sold a third of our position last week. If it were to break lower, we'd look at selling some more. There's lots of good companies. You don't have to own this one. But on the other hand, you know, I will say, and I've said it in every presentation I've ever done, if we get stopped out of a position and the technical picture gets repaired, and it continues to be one of the best fundamental stories we can find, we will buy something back at a higher price than what we sold it at if it's one of the 20 best stocks that we can find. So there's some framing. We'll see what happens when their earnings come out. If they're able to surprise to the upside, great. It's still a 3% weight in the firm. But that being said, it has been trimmed. Industrials. We talked last week about the fact that industrials broke out of the range. The equal weight industrials versus the equally weighted S&P has been rising since April of 2022. This has been a leading group, and it continues to be. Every time we got down to these support levels, they reaccelerated. When we look at the mid-cap industrial ETF, AIRR, made up of companies that sell industrial products into infrastructure and U.S. manufacturing, it's up 9.2% in the last 9 days, behaving really well alongside the Russell 2000. One of our leading companies, BWX Technology, that makes small nuclear reactors, we think are the future, you know, has responded really, really well. And after correcting down toward the moving averages, shooting right back to highs, better than 87% of companies in the S&P. The defense sector today made a new all-time high. The PPA ETF, made up of the large aerospace companies, you know, performing really well, generally rising. Relative strength has been positive, and Howmet Aerospace is one of our top positions here, along with General Dynamics. They report in 7 days. Lots of news on the way. Materials, after going through a consolidation through the tightening period, broken out over the last couple of months, specifically the gold stocks, which we talked a little bit about. We've focused in multi-asset, in other words, multi-mine companies with a proven operating history. We focused on Kinross and Agnico Eagle, trading better than 92% of companies in the S&P. See, there are other things to do other than just tech. Now, these are interesting companies because they're generating a lot of cash. And most of the big producers do pay a dividend, and we think those dividends can grow. Kinross's yield is 1.8%. They grew their dividend last year 23%. And we think at the prices we're at, we can see dividend growth to follow along. Agnico Eagle is another similar story, multi-asset in generally friendly jurisdictions. We think this gives us good exposure. Energy sector has been consolidating, although on the point and figure charts, the XLE, which is the broad-based energy ETF, is putting in a higher high. Most recently after consolidating, same thing for the energy producers ETF, higher high. So it looks like this group can maybe turn around and get going. One of the areas we haven't talked much about is energy infrastructure, and we do own the AMLP, which is an MLP ETF, which owns pipelines, and Pembina Pipe in Canada, which has had a really great run, trading better than 75% of companies in the S&P over the last year. 5.3% dividend, and they make money when volumes go up, and Canadian volumes of exports are going up because of some of the improved pipeline capacity. So lots of things to do. In the spring, we added utilities as a group that had been really out of favor. We saw some improvement in breadth. We bought NextEra and Southern Company. They're performing very well. They're now trading all above all the long-term moving averages. We saw about 6 weeks ago a shift in some of the real estate investment trusts. We added Simon Property Group, again, good yielding group, and this group clearly believes that rate cuts are coming. Relative performance versus the S&P does look like it's making a shift. We start with one position, and if they prove out and continue to gain, then we'll look at adding. We have to take sort of a methodical approach. Groups that are not participating, consumer staples, food and beverage, really not participating in the consumer. Really, our only exposure is in companies like Loblaws here in Canada, Dollarama, Costco in the US, selling a broad number of consumer staple products and really good operators. Those companies are performing well. The other area in the consumer that's behaving well is home construction materials. And in particular, we're not so much focused on luxury homes. We're focused on materials that are used whether we want to or not. Owens Corning would be our biggest position in this area. Of course, they sell roofing tiles. Turns out when they wear out, you got to replace them. Owens Corning performing quite well, but we are staying away from luxury goods. If we look at the S&P textiles, apparel, and luxury goods sector, really not performing for obvious reasons that people are concerned about higher rates and squeezing the consumer. This is a group that doesn't do well. Same with autos. So when I get off the call, I suppose I'll hear what's happened with Tesla. My guess is the numbers are going to be a little bit tough. I think that auto sales in general are difficult, but it's going to come down to the commentary. US telecom stocks really not performing. Area we're not focused in. Healthcare has done a little bit better, but still on a relative basis. There's other areas we want to focus in. Our focus here have been in Lilly and Intuitive Surgical, but we do have an underweight area. Intuitive Surgical, though, really is performing very, very well, and of course is minimally invasive surgery equipment that is sold to hospitals to save costs and to get better outcomes, and of course they're doing really, really well. There's the Simon Property Group. So I think the story is mid caps and small caps. My guess is this rotation is real. This is one of the ETFs we own in our macro portfolio. It owns strong relative strength mid-cap stocks, and you can see it's breaking out to new highs. So something certainly to watch. From a sector perspective, if we boil it down, the sectors with the highest percentage of stocks performing well are concentrated in financials and industrials and energy. At the far left side of the spectrum, sectors that have the smallest number of stocks performing well, healthcare, consumer, those are really sort of the two weakest areas. But you will notice that over the last few weeks, most of these have turned from small letters to capital letters. And that means that breadth is expanding in every one of these groups that are in capital letters. The picture looks quite different than it did in the beginning of the month of June. Semiconductors being one of the obvious outliers. So let's boil it down. This is an index called the Value Line Geometric Index. It's an index that not many people look at anymore, but it's one that I always find interesting. It's an index made up of about 1,900 companies. It's an index where every company is weighted equally. And you can see really it made no progress. The average stock, 1,900 companies from 1998 to 2024 made no headway. Well, it did in 2020. as we came out of COVID. And then we went through a tightening cycle. And my guess is this is very close to breaking out. That would be a real positive. That would tell us that the broad market is waking up and we are less concentrated in a small number of stocks. From a sector exposure perspective, of course, financials continue to be a very large overweight for us. Technology is an underweight, but we think we have great companies. Industrials overweight, energy's overweight, and materials overweight. All of these more or less economically sensitive groups, a lot of them companies that have an ability to raise their dividends. Our exposure to defensive sectors, places we would go and hide if we thought that we were headed into some kind of recession, are really not a big part of our portfolios currently because we're not getting the signaling there that anything is changing for the better. We are pretty fully invested, very small amount of cash. So we're in the liquidity cycle. Liquidity is good for asset prices. Volatility is very constrained down around the levels that we tend to be at during cyclical bull markets. And I'm sure we'll get corrections along the way, but my guess is based on the setup, anything that we see will be quite mild. Recently, we accelerated putting some of the portfolio capital to work for new accounts that came in based on the change in the Russell 2000. We think the market's in a pretty decent spot. We're very happy to get defensive if we start to see negative change, even if it's our favorite stocks. But as we sit right now, we think we're in a pretty good spot. So a bit of a long-winded story today, 45 minutes. It looks like I probably went over my time allotment. But let me just take a quick look and see if I see any questions. Question from Steve. I have, and I know you have, exposure to the oil sector. In your opinion, where are we in this cycle? Usually is a boom-bust industry as other cyclicals like mining. So we think that this is a sector that went through a bear market. In fact, the sector went down 90% from 2014 through 2020. That's a bear market. And we came out and made new highs in 2021. As the Russell 2000 rallied and squeezed in some shorts, we think that there are hedge funds that probably looked for things to bet against if the economy was weaker than the market thinks. Inventories, we think, are very low, but hedged funds bets on paper are pretty high. We look at companies like Imperial and CNQ that are generating a boatload of cash at current prices, that are showing a real willingness to pay us as shareholders by buying back shares and increasing dividends. And we think it's not unreasonable to get a 4+% yield with 20% dividend growth, and the earnings can probably go up 20% a year over the next 5 years. So that's contingent on energy prices staying strong, which we think they will. So we're bullish, but we're not adding anything new until we see a new pickup in strength. A question from John. Hello, David. What do you think about NVIDIA, Broadcom, Apple, and Microsoft in the long run? We think they're great companies. We own all four. We own less NVIDIA today than we did a week ago. Broadcom pays a great yield with great dividend growth. Apple looks like it has an opportunity to reaccelerate some of its revenue growth. There's a big replacement cycle in iPhone as AI features are coming. And Microsoft is right in the heart of the sweet spot for AI. They're well owned by lots of people, and they can certainly correct. But they're high quality companies, and we think that they look really good. An anonymous employee, copper has backed off. Do you think it's close to a bottom? If you look at overbought, oversold, we think it looks oversold. The Chinese let go of a lot of copper over the last 2 months. Clearly, their real estate development industry is in some difficulty. We think ultimately there is a squeeze, and we think the companies that are producing, have pretty good numbers. Freeport had decent numbers today, and Tech Resources has got their new mine open and it's performing pretty well. So we think that this is a good area. And again, Remember that commodities went through a very long, difficult bear market, and this is a sector that does well after long-term bear markets because capacity gets shut down, mergers and acquisitions happen and rationalize the industry and gives the remaining companies an opportunity to make a lot of money before the next wave of building of mines. I think that's it. I think I got all the questions. Do we think that Canadian banks can perform well and lead the TSX in a bull market run? We own Commerce and Royal. We think that they both look really attractive. In case of Royal, their wealth management business is dominant in Canada. And their capital markets business globally makes them one of the biggest banks in the world. So this is a company that we think can continue to do quite well. Although we think some of the capital markets banks in the US are also attractive. And then the last question is on Fairfax. Do we think that Fairfax becomes more acquisitive? Well, you know, they announced this week that they want to buy Sleep Country. They privately bought Sporting Life a few years ago, Sports Check. They think that they'll continue to make acquisitions. They seem to be pretty good at it. They've done a very, very good job at employing their capital in productive ways. We're stakeholders and we back management as it is right now. So we do think that there's a tailwind in that industry also. I guess that's it. Okay, hopefully everybody's got things to do this evening. It's a beautiful summer day here in Toronto. We'll be very interested to see the reaction over the next 2 weeks to earnings. There'll surely be some companies that disappoint. My guess is in general, companies will beat this. They've tended to by 3-4% above expectation over the last few quarters. And we'll assess how investors react. So thanks so much, and tune in again next Tuesday.